If there's no dollars and everybody's running out and paying insane overnight rates for these things because they need them, well, what happens when we have a treasury auction? Who's going to buy those bonds? Well, we saw in 2019 what the answer was. The Fed. The Fed will buy the bonds. So they've got to turn on QE and they got to go out there, they got to print money and they got to go buy them themselves. And that's what will happen.
Yeah, it was the 3 fights in that first minute.
Yeah, the first 9 seconds, and two of the players, two Kachuk brothers. I played with their dad.
Oh, cool.
Keith Kachuk. He was out at Boston University, and I played a lot of Boston hockey in Boston because being a Boston Bruins draft, I would go out there in the summers, and we would all train together. So we all trained at Boston University together. And Keith, that first year of college, he had broken his foot and he had gained some weight, and he was kind of getting it back on the horse. And I was like, how are you? You're like, the draft is in a couple weeks. And he ends up getting drafted first round for Winnipeg and becomes an absolute superstar in the NHL. He's a powerhouse. Awesome. And now his kids, it's just weird watching his kids. They're becoming powerhouses too.
That's so cool. So I know nothing about hockey. I really enjoy it whenever I watch it, but I know nothing about it. But I thought that there was like enforcers on a team. So there'd be someone that was like the guy who's going to fight someone if it kicks off.
Oh, yeah.
But then there was like 3 fights in a minute. So how many enforcers are there?
Well, this was a different situation. So what you're talking about is they are enforcers, they used to call them goons, but they would, what their purpose, they're typically very large defensemen or just wings that they put on the fourth line. And their purpose was go out and intimidate the other team to protect the best players. So like, Marty McSorley was out there to protect Wayne Gretzky, like you can't take a shot at these guys. Mm-hmm. And so you've got to have somebody that will, if you're going to go and try to take out our best player, we're going to send out our enforcer to take you out. So you better be prepared. So it's kind of old time hockey. But this situation was the US comes out there, the game's up in Montreal. It's a super liberal city. And, the crowd starts booing the national anthem. And that's, okay, I get it. There are people who don't agree with Trump and all that, whatever, the politics put aside. You don't boo somebody's national anthem. It's just such poor form. And so the Kachuk brothers just probably looked at each other on the bench, were like, no,
let's have it.
And then they're like, literally dropped their gloves the moment the puck dropped, and they were ready to fight. It was crazy.
Love it. And is the rule that if you stay on your feet, you can just keep fighting?
Well, it's not really a rule. It's the refs don't want to get in the middle of it. Okay. So it's dangerous, right? So they're not going to go and try to break it up when you've got these enforcers or these big guys, trying to punch each other in the head. You're a ref. You don't have any padding on. So they wait for them to drop, and then it gives them the opportunity to get in there and break it up. So,
and then are you sent off for the game, or do you just get like sin binned? How does it work?
I'm not sure what the rules are in the international play, but yeah, you just get a major penalty and you're back on the ice a little while later.
It was a fun start to that game. So this is the final now tonight.
This is it. USA Canada.
Who won that last game? I only saw the fight. I didn't see the result.
I was actually, I can't remember. I was traveling, and so I only saw parts of it, but I did see the fight. But I've got a bet on tonight, and with this NHL player, the former NHL player he's actually in the Hockey Hall of Fame. This guy Chris Pronger. He used to play for St. Louis, and he was a big rival when I was living down in Dallas for a long time. People hated him. So it's funny because now we're friends on Twitter, but it's where I'm trying to turn him into a Bitcoiner. So I said, let's bet 100,000 sats then make it public and give the sats away. So,
that's good. I do a lot of boxing, and the thing that I find most impressive is that they can stay on their feet on ice skates and still fight.
Here's the thing though, Danny, I've been skating since I was just under 4 years old. And so it's actually easier for me to sprint on the ice than it is in the grass.
Oh, really?
It's much smoother. Yeah, it's a smoother motion, and so when you play that many years, it's hard to bring you down. Like my wife, the first time I took her ice skating, she's like, "Oh, I'm going to drag you down. It's going to, it's dangerous." I'm like, "No, you're not." And so you hang on. You like, it doesn't. Your center of gravity is lower. You're used to it. So
yeah, I'm like Bambi on ice. I'm no good at it. But we'll make sure this is wrapped up so you can watch the game then. But Mr. James Lavish, you recently dropped a piece on liquidity, which is something I thought was really interesting. Like the piece was amazing. And it's something that I spoke to Jeff Ross a bit about recently. So I wanted to kind of get into more detail on it. But can we set this up can you explain what you actually mean when we talk about sort of global liquidity?
Yeah, I mean, and this piece came after I had this conversation. Substack had this investor, it was a financial newsletter day. So all the writers of financial newsletters got together and they kind of paired up and talked to each other. And so Michael Howell and I got together and we talked about liquidity. And Michael Howell is from Cross Border Capital. To me, he is the leading analyst on the globally leading analyst on global liquidity. The guy knows what he's talking about, and he follows this stuff very closely. He's got proprietary models that are powerful. And so we talked for a little over an hour, and so a lot of what my piece is of that newsletter that you're talking about is kind of going just a little bit deeper than our conversation. We kept it pretty high level for everybody to understand it. So what we talk about, what we mean when we talk about global liquidity is just, you hear about like M2, the money supply and how that's driving the stock prices and sometimes and of course real estate and so asset prices basically. And so, but where does that come from? Where's that? Is it the Fed printing money? Is it banks lending money? Like, how is this? Like, how is there more liquidity? Is it hedge funds? Using derivatives? Is it cross-border transactions and lending? Like, how does this actually? And the answer is it's all of it. And so you have to look at all of it to try to get a sense of how that money supply is either increasing or decreasing. So going back to first principles, Danny, you know this, but for the benefit I know you know a lot of what I'm talking about, but
assume
for
I
the
don't.
benefit of your audience, you will, for people who don't know this stuff, when we talk about the money supply and the expansion and contraction of it, like first principles, first of all, our central banks have manipulated the money and they've created an absolute disaster with the amount of manipulation that they're doing with the money supply. Mm-hmm. They're either adding it to the market or they're taking it away. And when they do that, you have these booms and busts of economic cycles, which are not really as natural as they should be. So we talk about the money supply. Most people think, oh, is the Fed printing money or are they taking it out? So are they doing the QE, quantitative easing, where they're printing money and they're out there buying bonds and US treasuries and mortgage-backed securities in the open market? Or are they doing QT, quantitative tightening, where they're selling their own securities from the Fed, from the Fed balance sheet, they're selling them into the open market, and that will take money out of the system. So when you're buying it, you're injecting the system with capital that wasn't there before. They just print it from the Treasury. It's not really printing. What they do is they press a button and it shows up on the Fed's balance sheet. The Fed gives it to a bank. The bank goes out there and buys it. It ends up on the balance sheet of the Fed, and that's kind of how they do it. Recently, what they've been doing is quantitative tightening, because we had lowered all the interest rates down to zero, and we had printed all that money and bought all those bonds. Then when inflation spiked up over 9%, the Fed raised rates, and they stopped doing QE and they turned around and started doing QT, which means that they were taking money out of the money supply by selling bonds, the bonds that were on the Fed's balance sheet, into the market and taking that capital back out. Okay. So that's what people think about, but there's a whole lot more that goes into it. And Michael has done a tremendous job of analyzing and explaining this, and some of it's a central bank reserve, some of it's bank credit, the loans and credit lines to consumers and commercial lines, to companies and businesses, and so that's important. There's shadow banking, which is non-bank financial companies, which
is that
are
like the Eurodollar system?
It's like that's actually like hedge funds,
Okay.
so private lending kind of thing. And then cross-border flows is what you're talking about, is capital moving between countries, right?
That's the one that I probably understand the least. Like, how do cross-border flows impact liquidity?
Yeah, I mean, it's just whether capital is coming into your country or coming out of your country, and it moves that exchange rate up and down, right? And of course, it influences, like we talked about in the newsletter, some financial stability, right?
Mm-hmm.
So if you think about a foreign investment comes into your market, like into bonds and equities, that's adding to liquidity, and outflows will drain it. So global liquidity is not changing, but the liquidity in your region
I
is.
see.
So, and then of course, currency exchange rates will impact it too. But other things that people don't think about that Michael's done a good job analyzing, and this is all his proprietary models, but he also adds in their bond volatility. So these are all the things that go into global liquidity. So bond volatility is important because people will use their treasuries, they'll use their bonds as collateral, right? So they'll put their bonds to somebody, lend them to somebody, and they'll borrow cash for those. And how much cash they get for that, the loan to the underlying value, right? Depends on the volatility of that instrument.
Mm-hmm.
So if the bond is really volatile, well, they'll lend less money because it's more risky. But if it's not as volatile, they'll lend more money, right? So the loan to value will be much higher if it's less volatile. So the volatility really does matter. And that's just another aspect of that calculation. I don't have the calculation, but he's got some incredible charts about it and how these liquidity cycles move. And what he's found is that they kind of move in 5 to 6 year cycles. And in this latest cycle, it looks like we bottomed out in October of 2022. And now the liquidity is coming back. Like, all the central banks were drawing capital out of the system, and that peaked in October 2022 with not just that, but bond volatility, lending practices were down. It's all that goes into it. And so now it's kind of turned back up. You get more confidence in the economy. The central banks stop tightening rates and they start lowering rates a little bit. The lending picks up and all of that. So, and then it kind of turns back up, and it looks like we're in the upswing. And if you do that 5 to 6 year period, it looks like we're gonna peak in liquidity somewhere around the end of this year to beginning of next year. So and that influences all the markets.
What Bitcoin Did is brought to you by our lead sponsor and massive legends, Iron, the largest Nasdaq-listed Bitcoin miner using 100% renewable energy. Iron are not just powering the Bitcoin network, they're also providing cutting-edge computing resources for AI, all backed by renewable energy. We've been working with their founders, Dan and Will, for quite some time now, and have been really impressed with their values, especially their commitment to local communities and sustainable computing power. So whether you're interested in mining Bitcoin or harnessing AI compute power, Iron is setting the standard. Visit iron.com to learn more, which is IREN.com. This episode is brought to you by River, the best place for Bitcoiners and businesses to buy Bitcoin. With River, you can set up zero-fee recurring buys, making stacking sats effortless. And while you're waiting for the perfect buying opportunity, River lets you earn daily interest on your cash balance paid in Bitcoin, which outperforms most high-yield savings accounts. What really sets River apart is their unmatched dedication to security. You have peace of mind knowing that River has monthly proof of reserves and holds all Bitcoin in multi-sig cold storage. And with US-based phone support, you'll always have someone ready to help. To open an account, go to river.com/WBD and earn up to $100 in Bitcoin when you buy. That's RIVER.com/WBD. So maybe before I ask my next question, how does that impact the markets? Like which markets does that impact the most? Is it like risk assets benefit from this in the biggest way?
Yeah, risk assets definitely benefit the most from liquidity, and so you're looking at primarily the biggest beneficiaries are the high flying tech stocks, the S&P, and then of course Bitcoin has been an incredible gauge for global liquidity if you look back in time. The only thing is Bitcoin it trails liquidity, so so if liquidity is up, then it takes Bitcoin somewhere between 2 and 3 months to catch up. So if you overlay those charts though, the Bitcoin chart and the global liquidity chart, man, they look really close. And so that's what you're kind of watching, but it's a 3-month lag. So
Okay.
right. So it's not a great indicator, but it absolutely is directly correlated today. This may not be forever. I don't think it will be forever, but today it is absolutely directly correlated to the money supply and liquidity.
So do you think as Bitcoiners, instead of paying attention to the 4-year cycle in such a great deal, because that obviously has diminishing effects, do you think liquidity is really the big driver of Bitcoin?
That's a loaded question, but it is absolutely, it absolutely matters. You have to have liquidity for an asset like Bitcoin over the last few cycles to expand and for that price to rise. Will that break eventually? That being so tied to the liquidity cycle, I believe it will. We're not there yet. We're in the middle of it still, but it won't break until there's a reason for people to own Bitcoin other than speculative. And at this point, most people just believe it's speculative. You and I know that that's not the case. You and I have a much longer view on this.
Yep.
And we understand that Bitcoin it's an important allocation to have in your portfolio for multiple reasons. One of them is not just to keep up with the money supply, because money supply drives inflation and Bitcoin goes up with the money supply and saves you from inflation. Now it will matter, but will it be the leading indicator, or will it be the most important thing with Bitcoin? I don't think so. And eventually, it's not there yet though. When it happens, it's when Bitcoin is now taking market share from the rest of the global asset pool, right? So right now, it's been taking market share arguably from gold, and some from equities. Not a lot. I mean, there's $115 trillion of equities in the world, almost 120, and so there's $120 trillion of cash. There's $330 billion of real estate and $300 billion of bonds. I might have those reversed, but the point is, there's $900 trillion. I said billion. Did I say billion? I meant trillion. There's $900 trillion of total assets if you add those all up. 18 trillion of that is gold. So when Bitcoin is taking from gold, but it'll eventually start taking from bonds, is my belief. And that's a little bit down the road, and we can talk about that a little bit later.
So, I mean, everything, I totally agree with what you say there. Like, I don't see Bitcoin, like I'm all in Bitcoin, and I definitely don't see it as a risk asset for me, but I think the broader market still sees it as a risk asset. Do you think that's something that will change in the kind of near term?
I think it's going to change when the volatility dampens a bit.
Yeah.
And that's going to take time, because people see the volatility and think risk. They don't realize that volatility in a rising asset is actually a good thing. Why is that a good thing? Because it allows you to accumulate opportunistically. And so, and it's rising though over the long term. So it allows you to take advantage of drawdowns, especially. And then the reality is, I mean, look at what Michael Saylor's done with MicroStrategy, now called Strategy. He's able to expand his balance sheet and buy 479,000 Bitcoin, borrowing capital from the markets to do it. he's found a way to optimize his ability to borrow. How does he do that? He does it because of volatility. The volatility ends up being a good thing. So what he's done for your listeners is he's been issuing convertible bonds at 0% interest. Zero. No, he's not paying any interest on these bonds.
Yeah.
And people are like, wait, people are lending him money for free to go buy Bitcoin. Are they nuts? Good question. The answer is no. These are professionals who know that the volatility is beneficial to them because they're buying something called a convertible bond. And that bond can convert into stock at a price above where that bond is issued. And so if they buy this bond, they know they've got upside optionality from the stock. Well, the stock is tied to Bitcoin. Bitcoin's volatile. The stock is volatile. So why does that matter? Well, now they've got this convertible bond that you've got the ability to convert into stock. So if you're a convertible bond owner in a hedge fund, you're buying these bonds and then you're selling short MicroStrategy to delta hedge against it. What is that? That's the optimal hedge to have against that bond of stock, because this is going to convert into this. This can convert into this, right? And so there's an arbitrage. This is the same thing as this in a ratio. And so they can find that optimal point, which is the delta hedge, that they can trade around and make money as the stock goes up and down. They can short more and then buy it when it comes back in, and then short more as it goes back up and buy and make money along the way as that stock is rising with Bitcoin. And it ends up going into the money, and they make all this money off of that optionality on the upside from owning the stock, owning that bond, and then eventually the stock. So volatility ends up being a wonderful thing for them, not just for Michael, but for the bond buyer.
Even if it's downward volatility.
Well, no, the downward volatility is, we've seen downward volatility in companies that are dying, and that's not a good thing. But this is a company that has revenues that can easily keep up with the payments of the early bonds, and that leverage them to be able to do what they're doing now and borrow money for free. So, the volatility in a decreasing asset's not a good thing. It can be a good thing if you're a hedge fund that is able to short it on the way down, but for the typical investor, it's not good.
Okay, let's get back. I want to pull this chart up that you did.
Yeah, this is Michael's chart. I want to be clear. Cross-border capital's down there.
Okay, can you talk us through this though?
Yeah, so this is the black line is that's the global liquidity measure according to Michael, and that 65-month wave is just that. It's that wave line that is it's a derivative of that time period, and it goes in that, it's like a sine wave. Mm-hmm. And you can see that the global liquidity cycle just follows it, not to a T, but you can see that close. The peaks and valleys kind of hit in those same periods.
Yeah.
Right. So when you go back to like 2000, you can see that global liquidity was coming out in 2000, 2001. There was rising after that. Uh-huh. And go to 2008, you can see how global liquidity, it peaked right at that global financial, the great financial crisis. And then, it just collapsed. But you see how it stops there in 2010, 2011, 2012, that black line kind of stops. Well, that's central bank manipulation. Right. So they kept it from contracting too much, too rapidly. And then the upside, they, in 2014 to 2018, they were keeping it from expanding too much. But then you get back into 2019, you see how all the capital's coming out. Well, that's where we had, right in 2019, we had a crisis here in the United States. I've talked about this a few times before, but there was a repo spike. What is that? Well, this is a great chart to see what happened here. You can see right there, 2019, you've got the liquidity kind of bottoms out. Well, what happened was the Treasury in September to October of 2019, the Treasury was, they issued their QRA, their quarterly funding announcement, talking about how many bonds they're going to issue, how much money they're going to borrow. And it surprised people. But at the same time that you had companies making their tax payments for the fall, at the same time the dollar was strong, and it was difficult for foreign corporations to buy treasuries and foreign entities to buy treasuries. This all came to a head in the fall. And what does that mean? Well, there weren't enough dollars, basically, for people to take their treasuries and put in the repo market. There's a private repo market back then that you could put your treasuries to another company. Like hedge funds do this all the time. They've got $100 million of T-bills or actually treasuries that they want to borrow against. They'll lend them overnight to another institution, to a JP Morgan or something. JP Morgan will give them dollars for that, and they'll pay an annualized rate on that overnight for that repo, repossession.
So they swap treasuries for cash when they need some liquidity.
Exactly. Mm-hmm. And so there's an interest rate for that. Well, during this crisis, the interest rate went through the roof overnight. It was like, something is wrong. Something's broken. Somebody's blowing up. They need cash. This is really bad. And the Treasury and the Fed panicked, basically, for good reason, and said, oh, we've got to, stop QT and turn around and put more liquidity in the market. And so back in 2019, you can pull up a chart on Fred and see the Fed balance sheet. And you can see that the money supply started expanding. So the central bank, the Fed's balance sheet started expanding back in the fall of 2019 before we ever even had COVID. So, and people forget this because COVID was so jarring that they forget that this happened all the way back then. And so, but that's what that's showing. And then the money supply just expanded straight through 2021 into 2022. And then the Fed turned off the spigot and it came back in. And it bottomed out in October or so of 2022. And we're back rising again.
And I remember doing a show on the previous What Bitcoin Did with Caitlin Long and Travis Kling back in 2019 when that repo market was blowing out. And they, at the time, they were saying that like this signifies something is really, really wrong. And then like 2 or 3 months later, COVID happened and we know what happened then. Is that kind of like the efficient market hypothesis playing out?
Kind of, I mean, like there's only, the problem though, Danny, is it's not even the efficient market. It's the manipulated market playing out. Like how much they have to manipulate to keep it in order. Mm-hmm. Then what you have people like, when you have people like Larry Lepard, he believes that we're getting really close to these. There it is right there. You see that right there? Mm-hmm. That little bump right before 2020. So the Fed had been doing QT from 2018 down into 2019. And then there's a little bump there. Like they stopped, like abruptly stopped QT and started QE. And that was because of the repo crisis. And then you get into 2020 and you get into the COVID lockdowns and the absolute disaster there. And look at what they did. They doubled the balance sheet. They put $5 trillion on it. Insane. So, and this is why all these problems, so not efficient market thesis or theory, but it's more like manipulated market theory.
Are you quite surprised with how far they've been able to draw down their balance sheet since sort of coming out of COVID here?
You mean being able to sell off all this now? No, yeah. They've barely been trickling it out now. Now they're not even doing QT really. They're just letting the bonds that they have on their books expire without replacing them. like mature. So they let them mature. They don't replace them, and they're calling it QT, but it's $25 billion a month. It's nothing. It'll be, it's kind of, it'll be significant when they stop QT, because it just signals that, we're going to have to start the spigot again. And then you heard the Fed's bosses say today, and I think I retweeted, he said the possibility of slowing quantitative tightening is not just about the debt ceiling, but also because the Fed does not want to overshoot. I mean, they blinked. They literally just blinked, and they're like, we've got to make sure that we don't we've set ourselves up to be able to get to QE before it gets too late, which goes back to the charts that you just had up, that red chart you had up. And those are all the factors they're looking at. And so what happens is the Fed's looking at all this, and Powell, the last meeting, he flat out lied, I mean.
Why? What did he say?
He said that, there's plenty of liquidity in the bank, right? And he basically said that, what was the word he used? He said that they're abundant.
Was it? Yeah.
Yeah. So abundant. So here's the thing. He's been asked this before. He hasn't been asked it in a while. I don't know why these reporters are giving him such softballs, but ask him the real questions. Like, these are the things that really matter. He was asked about, when does he start getting nervous about bank reserves, because the reverse repo was being sold off. So now we got to unpack that, right?
Mm-hmm.
So what's the reverse repo? We just talked about the repo, where if you need capital, then you can take your treasury, lend it, get some cash for it overnight. Well,
I think you described it as a pawn shop to me.
A pawn shop, yeah, it's pretty much it. Exactly. But, you get it back.
Yeah.
And they're not going to sell it on you, though. So, or the reverse of that is a reverse repo, which is you've got too much cash and you don't want to tie it up for too long because you may need it in a few days, but you'll lend it to somebody for their treasuries. Okay. So what happened? Well, you had that chart of the Fed balance sheet expanded over $5 trillion. So what happens? Well, that money finds its way into banks' hands, into consumers' hands, into investors' hands, because they're buying securities in the open market. Well, then what do these investors do with all that money? Well, they put it in money markets. So if you got your Schwab or your Fidelity account and you have cash and that goes into a money market, it gets swept into a money market. You sell a bond, you sell a stock, it gets swept into the money market overnight, and then you're sitting in a money market. Well, where does that money market go? Well, what do they do with that? Well, they typically buy T-bills with them, right? But now we have something called the overnight window, where the Fed has this window always open because of the repo crisis. So now they've got this window always open. They got the reverse and the repo and the reverse repo window always open, the two windows, and you could use them every night if you want to. You can look at New York Fed at what the balances are and on the website. And so it's available for investors to just take that cash and put it in the Fed and get paid for it really handsomely. So what these money markets are doing is they're taking the cash, they put it in there overnight. Instead of buying T-bills, they've got ready capital right there, and it's a great return.
Mm-hmm.
It was 4.5%, 5% over that return. It was almost 5.5% at one point. And at one point, all that capital that they had put into the market, this liquidity. So these are the things we're talking about. Liquidity goes into the market. Where does it go? It goes into stocks. It didn't go into bonds a little bit, but not much. Goes into real estate, different things that people the investors are buying. But it also went into reverse repo. The reverse repo got up to over $2.5 trillion. So think $5 trillion got printed, $2.5 trillion went into the reverse repo. It didn't come directly from there, but the excess liquidity went into that market. Yeah, you can see that's the reverse repo. Okay, so you could see up there that it got when it spiked all the way up to like $2.5 trillion.
Yeah.
Now this is not a daily. I think I did this on a weekly or something. So you can't see the interim weekly spike, but it got up there. Now it's all the way down, and it's even lower. This is like $50 billion now. So what has been happening? Okay, so you could see that at some point in there, at the somewhere in 2023, in the summer of, well, why does it start coming down so much? What's happening? What's the function there? The function is that Janet Yellen figured out that, oh my God, we have such large deficits. And she had, there are a lot of policy errors here, but the main one being the Fed and the Treasury teaming up to print so much freaking money and just flooding the market with it. But another policy error is she did not issue longer term treasuries and get all of her T-bills off the, out of the system when there was zero interest rate policy. So at the time where she could borrow at such low rates, she didn't do it. And so all these bonds were maturing during this time, and we're running $2 trillion plus deficits at the same time. She's got to go borrow that money. So where is she borrowing it? Well, she started borrowing it on the short end because now interest rates are up. And so now she's got to just kick this can down the road and play chicken with the market.
This episode is brought to you by Casa, the leading Bitcoin self-custody solution. I've been using Casa for a few years at this point, and I can't recommend them enough. Casa have options for all Bitcoiners, from a 2 of 3 multi-sig to a 3 of 5, and a private client option for absolute best-in-class security. Casa also have an inheritance product, which I've recently set up, and it couldn't be easier. My inheritance plan has gone from a vague treasure map for my wife to a rock-solid plan that I have total confidence in. To find out more about Casa, go to casa.io, which is casa.io. This episode is also brought to you by Ledger. If you're serious about protecting your Bitcoin, Ledger has the solution you need. Their hardware wallets give you complete control over your private keys, ensuring that your Bitcoin stays safe from hacks, phishing, and malware. With Ledger's easy-to-use devices and the Ledger Live app, managing your Bitcoin has never been more convenient. Whether you're a long-time holder or new to the world of Bitcoin, Ledger makes it simple to keep your assets protected. If you want to find out more, visit ledger.com and secure your Bitcoin today. That's ledger.com. Is that her fault though, or is that because there was no market there for the longer duration bonds?
There's always a market there for them.
It just depends on the price.
Enough interest rate. If you just have to pay a little bit more, but you're not paying 5.5%, you're not paying 6%. Maybe you're paying a few percent. So maybe you're paying 1 or 2. But so now what happens? Well, now she enters the market, and she has to deal with all this, the deficit spending, and she's got to deal with these bonds maturing. And so what does she do? She goes and starts issuing T-bills. So they've been issuing massive amounts of T-bills over the last number of years. So
this is just like 1 year bonds.
They could be like a week bond, or two, just a few days, a week, and a month. And they're T-bills, super short. They're not even called bonds. They're called bills. Okay. And so she's doing that. And so she's drawing money out of the reverse repo. How? Well, because the money markets, right? They want to own the best yielding product they can, as long as it stays within their liquidity parameters. Well, these T-bills are great for that. So she teases all that money out. And so she's been teasing this money out of this reverse repo for years now. And now it's down to the tail end. So now she can't take money out of there anymore. Well, Bissett can't, because now he's in charge. He's been, he's taken over this pile. And so now he's looking at this, and he's been criticizing her all along that she should have gone out further on the curve. She should have gone further. I agree with him. She didn't. So now what happens, Danny? Well, we've got over $7 trillion of bonds that are maturing. That's that next chart you've got right there. This is the next year. This is what we have to deal with. Yeah, and in total, with interest, you've got over $10 trillion coming due here. And they got to deal with it. What are they going to do? Well, Bissett has been critical of Yellen this whole time. And now he stands there and he says, well, what am I going to do with this? So can I go out on the curve? If I start going out on the curve now, interest rates are, the 10-year is now sitting at, I think it's over 4.5% the last time I looked today. Let's see where it is here, Danny. It's at 4.51%. So that's the yield on the 10-year. Okay, what if you go to the 30-year? That's 4.75%. That's not going to work. I can't issue a 4.75% treasuries on $10 trillion. They'll blow us up. So I got to kick the can down the road more, keep blinking, or keep playing chicken, not blinking.
So explain that to me. Does that mean they're just going to roll over this debt into more and more shorter duration bonds?
Correct. But where's it going to come? Who's going to buy this? Who's going to buy these bonds? Like the simple buyer was the reverse repo market, which is the money markets. That was a simple one. Well, as these mature, let's make it clear here. Let's be clear. As these mature, a lot of that money, most of that money, the vast majority of that money likely just gets reinvested into it because people aren't going, oh, my T-bill matured, I'm going to go do something else with it. No, they're just they're keeping it there in the money market. It's likely going to remain there. And look, if people sell bonds, you heard what happens. I mean, people sell stocks in the market, you heard what happens. They open their Schwab account, they sell their stock, the stock gets sold, the capital comes into their account, it gets swept where? Into the money market. And the money market does what? It buys either the reverse repo or the T-bill, whatever is a better rate for them that fits their liquidity parameters. So that's what's going to happen. It's not like this sudden thing. So a lot of this money will get reinvested into the money market, get right back into the money market, right back into T-bills. However, there is one small issue that is on the horizon that we're going to have to deal with. We do not have a debt ceiling right now.
So this is something that I spoke to Lynn Alden a little bit about, because when Trump came in, I think the debt ceiling, it was basically like an issue straight away. I think on his first day, he had to do something about it.
Right.
So what's the state of that now? I've not really followed it at all.
Yeah. So what the state is, we don't have one. And so what happened was back in summer of 2023, we got to a point where we were in real deep trouble. There was no money left in the Treasury General account, which is the checking account of the Treasury that they have to pay bills with. And they had come all the way down the line to literally the last minute. They're going to trip some sort of payment that would be a default on something. So what they can do is when you say you cannot issue any more bonds, that's it. You're at your limit. You're at your credit card is tapped out. You can't issue anymore. That's where we are right now. It's where we were back then. So what they're doing is the Treasury is playing games internally and not paying things that they don't have to pay right now. And so what they're doing is they're basically saying, it's like saying, well, I've got a 30, 60 or 90-day grace on this. I don't have to pay this yet. I'm going to wait and not pay it yet. And they've got enough of those things that they can go. What Yellen had said was she believes they go into the summer with this. We haven't heard Bissett on it yet. And they can play those games into the summer. They've got over $700 billion in the Treasury General account. It moves around from day to day, but that's what the last time I looked at, it was right about there. And so, they're playing with that, and they're just gonna play chicken on this. So, all right. So this is where we're at now. You've got all these bonds turning over, and you've got a deficit. Okay, now you've got to talk about DOGE. Yes, DOGE they've saved $100 billion of spending so far. How much more they can do, who knows? They're uncovering a lot of nonsense and fraud and whatever.
But I assume you think the $2 trillion that this target was originally is out of reach.
I mean, let's talk through it structurally, right? First of all, let's set the stage. The U.S. government works on a October 1 fiscal, right? So the year begins October 1. Our first quarter just ended for 2025. So we got the data back. How did we do? Not so great. We ran a $711 billion deficit in the first quarter. And so the problem with that is it was 35 to 40% higher than last year. So anybody says, oh yeah, but there were no tax payments yet. They come in April and it always runs a high deficit in the first quarter. Yeah, great. But it was way more than last year. And last year we ran a $2.1 trillion deficit. Danny, you don't have to be a genius to do this math. 700 times 4 is 2.8 trillion. There's a massive upswing in deficit spending. Okay, so yeah, they saved $100 billion. That's great. That's awesome. We need to keep doing this. We're still running deficits because structurally we're at a point where we spend so much money, Danny, we can't keep up with it, right? So just think about it. I'm going to give big round numbers that will be close to what's going on. Yet our tax revenues are about $5 trillion and our spending is about $7 trillion. So you think, okay, if you just take $2 trillion out, you're great. Okay, let's talk through where's that going to come from? Well, your mandatory expenses, these, and I've talked about this ad nauseum, but I'll do it really quickly for your listeners. Your mandatory expenses, these are signed into legislation. You can't, you're not going to cut these unless you find fraud in them, which this is a new wrinkle, right? So that spending though, that's signed into legislation is $4.1 trillion annually. You've got defense spending, which is about $900 billion. So now you're at $5 trillion right there. But here's the thing. You haven't even talked about your interest on your debt. You cannot default on that. That is absolutely mandatory. Because if you
what is the interest at the moment?
Which is about $1 trillion annually.
Okay.
Net interest, because there's intergovernment payments and debt and loans and all that stuff. But the total mandatory expenses, that's $6 trillion. And then your discretionary spending, that's stuff that's not signed into legislation, which is the really easy fluff to get out of there, is $1 trillion. So that's $7 trillion of total spending. So where are they going to find that extra $1 trillion? Even if they cut every single discretionary program, they're not sending any money to anywhere else.
Which they're not going to do.
Which they're not going to do. But even then, where are they going to find it? Are they going to find $500 billion of fraud in the Social Security, Medicare, and Medicaid lines and line items? Maybe. Are they going to cut half the defense? No way. You're going to default on interest? No way. So it's got to come out of that top line. I'm skeptical. Or you have to raise your tax revenues. Oh, here we go. Raise your tax revenues. Well, how can you do that, Danny? Well, you can either expand the economy in real terms, or you can expand it in nominal terms. And that goes all the way back to the global liquidity and the money supply. It's really easy to induce and create inflation by flooding the capital with money, expanding the money supply, creating inflation, creating asset inflation, which creates consumer inflation, which creates inflation GDP. We're so financialized. They're closely connected that you end up having a higher GDP that your tax base is off of. Trump's not going to raise taxes.
No.
But taxes could go up in nominal terms because of inflation. That is definitely possible. So these are all the things that are going to play into how this debt maturing cycle plays out.
Where do tariffs fit into all of this?
That's a good question. Nobody really knows. We know one thing. We know that Trump has a massive ego and he loves wielding a big sword and getting these other countries in line. He is right. We have been trampled over for decades from these countries that are just using our balance sheet, basically. Now, he uses that sword and he threatens with tariffs all over the place. You saw the market reacted to his threats on tariffs and on Mexico and Canada and China in that one day. And then suddenly they're like, oh, we figured it out. We got a 30-day stay on this. We're good. Well, he basically, he wants to get people in line to do certain things that he wants them to do, whether it's to close the freaking border from Mexico, close the freaking border from Canada. Yes. It's absurd that they refuse to help us with that. Okay. Well, we're going to hit you with tariffs then. It's too painful for them. They know they can't deal with that. So they are going to come into line on that. And you saw the reversal instantly, almost instantly, instant reversal. They can't talk about, oh, we just don't want these people. They got to talk about the criminals. They got to talk about the fentanyl and all that. It's all just talking points, but they basically want to stop the flow of unvetted immigrants. Immigration's great. Our country was created on immigration. I'm not against immigration. I think it's very important. We've got all these colleges that are supposedly bringing the most brilliant minds from around the world to study at Stanford and the Ivy Leagues and Caltech and whatever. But
it just can't be unlimited immigration.
Can't just be unlimited. We got to have a process. Okay. So we got offline there. But the point is that he's using the tariffs for that.
It's just a bargaining chip for now.
Yeah. And for, it's a bargaining chip with the dollar and all of that, to let other countries know that, hey, we're not going to just take it. We're going to kind of be in control here financially. We're going to take back control financially. So it's unclear what tariffs will be and how impactful they will be on inflation. If you just take the straight line on it, sure. And tariffs on other countries' goods coming into here are inflationary if we need those goods, if they're necessary. If they're chips or if they're auto parts that we need, it's going to be inflationary. If it's goods that can be replaced, no. If it's goods that we already have here that they're tariffing ours and we're not tariffing theirs, well, then that makes strategic sense to me. Bring that money back home and let it go to our producers, our manufacturers. That would make sense, but that's painful in the short term, likely, and it takes some time.
So that's the scale of the problem, and it seems like a very big problem that the US has right now. Well, I'm sure it's not just the US, but what if you were Jerome Powell or Scott Bessent, what are the things that they can do to kind of get through this?
Well, I mean, Bessent's doing it. He's going to kick this can down the road and keep issuing T-bills until they can't. So this comes all the way back to the Fed and the problem and when they get nervous. So we talked about the last press conference that Powell did for the holding the rates steady on the Fed funds decision, monetary their monetary decision. And this is what he's doing. He's watching the bank reserves, and he said this a couple of years ago that he starts to get nervous when the reserves are somewhere around the 10% to 12% area of GDP.
Powell said this.
Yeah. So once it gets down below that area, then you're like, the reserves are, they're getting down to a point that they're not going to be able to keep up with this, with the debt we're issuing. And so that's where the repo crisis was, and it got down below it. And then you could see that's back in 2019. This is where we are now. That's where we are issuing all those T-bills. Well, the question is, this is the big question. Once we get out of T-bill issuance policy and we start going out on the curve and we start issuing bonds, what happens to the reserves? Because right now, the reserves are sitting at about $3.2 trillion. GDP somewhere about 29 trillion. So if it starts dipping, if they go out on that curve, they're drawing money out of those bank reserves in order to buy those bonds. So that the bank reserves are coming out, they're buying bonds, and then that number will drop. And that's what they start getting worried about, is that it drops to the point that it did back in 2019. And we have another repo issue where everybody needs dollars and they can't get them. There's no liquidity. They can't get them from the bank. The bank doesn't have enough to cover their risk ratios and their needs to lend it out. And it tightens up enough that you have a repo crisis and a run on dollars, not the dollar, but a run on available dollars. And that means that the interest rate goes up to borrow them. I mean, spikes up, and that's a problem. It's a problem because it locks up the financial system for the treasury. So it means if there's no dollars and everybody's running out and paying insane overnight rates for these things because they need them. Well, what happens when we have a treasury auction? Who's going to buy those bonds? Well, we saw in 2019 what the answer was. The Fed. The Fed will buy the bonds. So they've got to turn on QE and they got to go out there, they got to print money and they got to go buy them themselves. And that's what will happen. So
that was going to be my next question is, if they do start issuing long duration bonds, who is the buyer? Because like, again, I'm no expert in the bond market, but it seems clear that over the last couple of years, there's not really been a deep liquid buyer for long duration bonds.
Yeah, there has not. That's why you haven't seen a lot of them being issued. But hedge funds are out there. Those international buyers you see, and they're called international because they're out in the Caymans or but they're out there. Some sovereigns are out there, but we've seen a significant decrease in sovereign demand for long-term debt. There's a lot of reasons for that, and one of the reasons is that we made a catastrophic error in the last administration seizing bonds from another country. That was catastrophic. It doesn't matter if they're your enemy. It was absolute idiocy that they did that. I still can't believe it. When I heard they were doing it, I was like, I couldn't believe it.
Yeah.
Like, this is the gold reserve asset. You need the world to buy your bonds because you're so irresponsible with your spending. You need them. What are you doing? But they did it. And so that signaled to the world that, hey, look, if you're not a really close ally of the United States, you're out of luck, pal. We might just seize your treasuries. So what does that signal them to do? Well, own anything but treasuries. Yeah, buy gold. Why? Because gold can be turned into dollars. They need dollars. They'll get them. They'll get them with gold, or Bitcoin eventually. So yeah, and that's the question is who's going to buy these things long term. The BRICS nations have backed off from buying them. They don't buy them like they did before. The BRICS nation, Brazil, Russia, India, China, South Africa. Yeah.
So you think then the likely outcome of this is QE happens in like relative short order, quite soon?
I mean, you heard what Bostic just said. They just basically said, we're going to stop QT soon.
Mm-hmm.
That's a signal that we need to get ready because we may need to be in the market again at some point here in the near future.
And what kind of form do you think that'll take? Will it be QE like we've seen before, or because like in 2023 when the regional banks started failing, they did the BTFP program, which
right.
I know wasn't technically QE, but it kind of was.
Not QE, yeah.
Yeah. Do you think it will be something similar, or do you think they'll just outright do QE?
Well, it depends on what happens in the market. Is it a market shock? Is it something completely unexpected that causes turmoil in the bond market? If it's that, they're going to come out and just print money and buy. Mm-hmm. They're not going to care. They're going to stabilize the market. They will rationalize that we need to stabilize the market. And so that's what we're doing. And so, but if it's a contained crisis, like they were able to create an acronym for, well, of course they would rather do that and call it.
They'd rather hide it.
I mean, they're doing it right now. It's not technically QE, but they have something called a regular treasury buyback program. So they're out there buying treasuries in the open market from buyers who hold these illiquid treasuries. They're older treasuries. They call them off the run. And these are back in the day, the big bond traders, the banks, they would come into their desk and there'd be a big stack of, it was like you ever see dot matrix printers, Danny? You're too young. But
yeah, no, I know what they are though, yeah.
Holes on the side and they just, yeah. Well, they had these huge runs of these printouts of bonds, and they had all the bonds in there, all the treasuries, all the mortgage-backed securities. and they would, if somebody called and said, "Hey, what's the price of this bond?" There was no Bloomberg back then, so there was no pricing. Like there was no dynamic pricing for them. It was all on the phone, and there was no ticker for bonds, right? So at least you had stock tickers since way back when, since the Buttonwood tree, right? So, but there was nothing to look at, so they had to look at these papers, and so they'd look at the run and say, "Oh, this I'll pay you, 97, 0.5 for this one." Okay. But if they asked for a bond and it was like, well, it's not on the run, I have no idea, it's not liquid enough to even be in this massive stack, then it's called off the run. That means to be really illiquid. Well, now the treasury's out there buying those bonds that are off the run. They're just not liquid. And so why are they doing that? Well, they're creating liquidity in the market, making it easy for people to move their paper, and they're just replacing it by buying those and then issuing new ones. And so it's basically what's happening. Is that QE? Not technically. Does it add liquidity to the market? Absolutely. If you ask Michael Howell, he'd be like, of course it does. It's absolutely what they're doing. Is it a ton? No, but on the margin, it's adding liquidity, just like BTFP did.
So if this year is going to be like a big year for liquidity, I think Bitcoin, whether it's because of liquidity or not, everyone's expecting a big year for Bitcoin. What do you think will happen this year? Do you think we'll see 200K plus Bitcoin?
Well, I've been saying for a long time that my vision was, I was thinking there would be about $180,000 this fall. Now, a lot of things have happened since then. Yeah, see, here's the global liquidity. This is, again, Michael's chart and this is staggered. So Bitcoin is actually, I think, 6 to 8 weeks backwards here. So it has to catch up. But I think that what happens here, Danny, is that we have a lot of tailwinds that may push that forward. The 180,000. I still think that we can see it this year. We could easily double, especially with all the tailwinds. Well, what are the tailwinds? The tailwinds are there's a whole host of things that have been happening. You've got the gap accounting change where Bitcoin doesn't have to be held as an impaired asset on companies' books anymore. They can hold it at mark to market, which prevented a lot of companies from buying it. They just didn't want it on their books. The ETFs came out. The strongest launch of ETFs in the history. IBIT, BlackRock's ETF, gathered $50 billion of assets in less than a year.
Insane.
Blows everything away. Make it very simple now for anybody, both any institution, and meaning endowments, pension funds, even hedge funds who didn't want to deal with having their keys. It was easy for them to just step out there and buy them. And people who have their IRAs, and individuals who want to own Bitcoin but have no idea what to do with the keys and all that. Super simple. It's been a huge boon for Bitcoin. Then you had options on top of that, which helps drive even more liquidity in there, because then you've got sophisticated investors who are using options to hedge their strategy so they can even own more Bitcoin. That's another one. Then you've got SAB 121 was just finally fully repealed. That bulletin from the SEC that was onerous for banks to own Bitcoin and to deal in Bitcoin. It made it very difficult for them, and it basically threatened them that if they held Bitcoin on their balance sheet, that the SEC would audit them or come down with them because they weren't abiding by these really tight recommendation. And so, but it was finally repealed fully. That's off so that I think allows companies to start moving into this space. Meaning they're going to make it easy for you to buy Bitcoin right through your Chase or Wells Fargo or Citibank account, and then they're going to offer products around it. They're going to lend around it. They're going to the collateral products. They're going to be all kinds of stuff. So that's that. And then of course we've got this new administration who's clearly crypto friendly. I mean, the guy launched his own Trump coin and Melania coin. He talks about Bitcoin a lot, as has his family and his cabinet. You've got people around him who, like David Sachs and Bissett, these guys own Bitcoin. Lutnick. So that's all a big deal. And you've got Senator Lummis, who's been driving this bill, the Bitcoin Act. And has to
person the SEC.
What's that?
And Hester Peirce in the SEC.
And oh yeah, that's right. Peirce at the SEC, exactly. But another tailwind is the Bitcoin Act possibility. I don't think it's probability in the next few months. It's got a long way to go. I mean, Senator Lummis from Wyoming she authored the bill. She needs a co-sponsor. She needs to get it through committees and comments and then revisions and negotiations, and it's a gauntlet that they've got to run with that thing. It's going to take a long time. Nothing happens quickly in Congress. Nothing.
Mm-hmm.
It's got to get through both branches of Congress and then to the president's desk on something that he's willing to sign. He's likely willing to sign anything they get to him, but we'll see. And I don't see an executive order coming, because if you think about him signing an executive order that would make the U.S. government buy Bitcoin through the Exchange Stabilization Fund, like through the Gold Reserve Act, then he could buy probably $50 billion, maybe even as much as $100 billion out of that $200 billion fund of it. But it's a bad signal to the world that we're needing to stabilize our currency. That's just not, I just don't think they're going to want to do that. Yeah. As much as a lot of Bitcoiners are hoping that will happen, I don't see them acting that way. Remember, again, Trump he's got a huge ego. He wants the stock market up at all-time highs. He wants financial stability. He wants the economy roaring. And the way to do that is to keep kicking this can down the road, creating liquidity, making money easy, and keep going. And so, so those are all kind of tailwinds for Bitcoin on top of this expansion of liquidity and liquidity getting easy. So, or continuing. It's already been ticking back up. It's just going to continue. Probably into the end of this year, into next year.
So they'll probably get the Bitcoin Act solved just in time to buy the top.
Exactly.
Exactly. What do you think of the Bitcoin bond idea? I was speaking to Preston yesterday, and he was the first time I ever heard about that was with Preston on the show. Like these long duration bonds with a Bitcoin kicker.
I mean, it's interesting. I'm just not sure where the market is for it yet. To
me, that signifies massive dollar weakness, though. That even more so than like a strategic reserve.
Yeah, exactly. And that's the issue. It's interesting, but again, I just don't see that. I don't see that happening in the near term. I haven't talked to Press. I used to talk to him almost every day, but I haven't talked to him in a few weeks. I've been so busy with the fund. But yeah, I mean, I have to dig into that deeper to get a strong opinion on it. But on the face of it, no.
Yeah. How's the fund going?
It's great. Our first fund one, we closed early last year, and we've done well. We're up 82% net of all fees and everything in the 5 quarters we've been open, and we were up 65% net last year. For your listeners, the Bitcoin Opportunity Fund is it's a public-private investment fund. We invest anywhere in the Bitcoin space, public and private. The one thing that's different from us and the typical VCs in this space is that we're focused on later stage companies. I mean, we'll do some VC stuff, early stage stuff, but our real focus is on later stage companies that, we look at them and they have real revenues and real profits and real returns. And so that's kind of what we're looking at. And we've done well. So we raised that though, Danny, in the depth of the bear market. I mean, it was awful.
Yeah. How big was that first fund?
It was tiny. It was just over $12 million.
And you did a lot of like distressed mining companies and that kind of thing. Is that right?
We did some distress mining. We got early in on MicroStrategy and that thing. We did some interesting investments in things like we were lending Bitcoin to like a company called Cormint out in West Texas. He had access to excess solar and wind power out there that was just stranded.
Is that James McAfee?
That's James, yeah.
Yeah, he's great.
He's awesome. And so that was a great deal. That's been a fantastic investment for us. MicroStrategy, we got in very early on, made our biggest position. That's been a great one for us. So, but now we flash forward and we've more than doubled the fund. And so, on the asset terms. And so, but that fund's closed. We got people who are like, we're starting to get interest now that Bitcoin has gone from the $17,000 to $20,000 area that we were raising during, that everybody wanted to just run for the exits. Now we've got people interested because Bitcoin's up at $100,000. So
yeah, it should be a bit easier this time.
So we actually have people calling us, and we're encouraged because we have family offices, small family offices that are saying, hey, we want some capacity in your fund, but it's closed. So we're now in the middle of, we just started taking capital for Fund 2. And it's the same exact strategy as Fund 1. They'll invest, pro rata, pari passu on everything, according to their asset base. And so, but we've got some really exciting deals. This one, though, we're going to keep open.
Nice.
Which means that you can invest at any point or top up your investment at any point. What's important about this, though, is that because we're doing private deals, and some of the deals like that Cormet deal, we've got a few deals that we're in midst negotiation right now. Once they get in the portfolio, they're side pocketed. So if you're a new investor, you can't get access to that. Just to make it clear to people when we talk about these things, that's the one thing about this. The strategy is that you got to be in before the privates are struck. But we're super excited. We're seeing a lot of really exciting things. We're actually in negotiations with a guy that we'll just call it we'll call it a Bitcoin LBO, like the first Bitcoin LBO, and it's a non-cyclical bricks and mortar industrial service business, and we're it'll be on a Bitcoin. You'll use a Bitcoin treasury and it has fantastic cash flow, and it's kind of like a roll-up strategy. And it's something that Dave and I have done in our old world, in the straight hedge fund space and private equity space.
Is David someone you worked with before?
Yeah, David Foley is. I've never worked with him before this, but Dave Foley and I are the co-managing partners of Bitcoin Opportunity Fund, and so. But he's done a lot of corporate finance. He was a banker at Goldman, and he's Harvard Business School guy. We won't hold that against him, but he's a smart guy. He's a great guy. And so, yeah, but that's like a deal we're super excited about. That's just not typically what you would get in exposure in this space. So we're focused on things that we bring, like our experience and our knowledge. We bring that to the table, that we feel that's something that other people aren't doing and is super exciting. And we think that the most boring business like this can be the most exciting investment for us and our investors. That's kind of what we're focused on.
The big question, I think, is always for like any VC in the space is like, how do you beat the Bitcoin hurdle rate? How do you think about that?
Yeah. Well, I don't say we're going to beat the Bitcoin hurdle rate. Depends on what you think the hurdle rate is going to be, first of all.
Yeah.
So, our aim is to beat Bitcoin on a risk-adjusted basis for investors. So, tamp down volatility, still get exposure to the space and get exposure to things in the space. It's hard to tell exactly where we're at because we mark our privates at cost. So, unless there is an absolutely compelling reason for us to mark it up, like we're not doing a Series A, Series B, Series C, and then marking it up each way, that's what VCs do. We're not doing that. We're mark to market on our public investments. Liquidate the portfolio, you get exactly what you see back on your investment statement. The privates are just marked at cost right now. There's been nothing compelling to mark any of them up. So so that's kind of the hurdle rate, though, is look, we're trying to return. We're trying to create a fantastic return for our investors in the Bitcoin space. And that is a risk-adjusted return that is super attractive. If we can beat Bitcoin, that would be awesome. I'd love that. I'm not going to promise that to my investors. That's insane to promise. But we are heavily exposed to Bitcoin and Bitcoin companies. And so we should do well. If Bitcoin does well, we very well should do well. I can't say we will because the SEC would come down on me on that, but I have full expectations we would do very well in that case. So yeah.
Amazing. Well, thank you so much for this, James. Hopefully I'll see you in Bedford. But if not, I'll definitely see you in Vegas. We'll do something there. But is there anywhere you want to send anyone before we close out?
Yeah, I mean, talking about the fund, if anybody out there is interested in getting more information about it, because we are raising fund 2 right now, then just go to bitcoinopportunity.fund, www.bitcoinopportunity.fund, and just send in your request, and we'll get with you and send you some information or get on the phone. So there's that, and then of course I'm on Twitter at James Lavish. You can see it right here. I'm on Twitter. So, and I talk about all this stuff ad nauseum. You've heard it all.
Perfect. Well, thank you, James. I will April 11th, Bedford, cheat code. We're going again. I'll see you there.
I am excited about it and can't wait to see you there. And thank you for having me on. It's always good talking to you, Danny.
Yeah, that was great. Thank you, James.